Hey, how's it going, everyone? My name is Amos, and welcome back to the Dividend Compounder Show. So in this video, we're going to be going over the companies that are reporting their earnings this week. You can think of earnings as a company's status report for the past 90 days on how they are doing, their financial struggles, any market wins, and before we go any further, I do need to disclose that I just got back from eating at a Chinese buffet. You know, when you can stuff your face with as many plates of sushi and lo mein as you want. I'm struggling with the biggest food coma right now. So if I sound off, that's the reason why. And I just want to throw this out there. The reason why this video is being made right now is based on y'all's feedback. It seems like you appreciate this series, so hopefully we can do it again next week. If you like it, then let me know in the comments section, because I genuinely do read them. As a small content creator, no comment goes ignored. But anyways, based on the earnings, it's an opportunity for us as investors, amateur investors. If the market overreacts with emotion and they sell out of it and the stock goes on an overwhelming dip, but the fundamentals and everything else about the company is still the same, but they had like a temporary setback, then it's the perfect opportunity to buy on the dip, right? But also the earnings is a chance for us to evaluate and to see if the investment thesis for this company that we like, or if they've been on our watch list for a while, or if they are in our portfolio, if it still aligns with what we want in a high quality company. So there's a lot to talk about, and let's go ahead and get into it. And what you see on your screen right now are some of the more prominent household name brands that are reporting their earnings. So if this is all you care about, you can go ahead and take a screenshot of this, and I'll talk to you next time. However, if you choose to stick around, I'm going to be showing you and talking about and going on a deep dive for some of the other companies that are not shown on the screen. Case in point, I decided to collect them in this Word doc because there's so many companies that people don't know about that I think are hidden gems or are good businesses that are just, they don't have that market cap yet. Anyways, as we talk about Monday, the first company on the agenda is going to be McDonald's. And the ones that I am particularly interested in or invested into, I have highlighted in black, and the text font itself is going to be orange. I don't know what it is with orange. It's not even my favorite color, but I just feel like it's a color that kind of just stands out there, right? Nobody really chooses orange to be their favorite color or picks orange for anything, to be the color of your car, to be the color of your hair, to be the color of your t-shirt. It's just a color that exists. And that's why I think I'm kind of drawn to it. But anyways, McDonald's is posting their earnings on Monday, and I think this is going to be a big one for Wall Street because McDonald's is kind of like the poster child for the status and the financial health for the rest of the quick food service industry. However, based on my research and what's going on, I think a lot of the companies that are similar to McDonald's, right, like Burger King, Jack in the Box, In-N-Out, I think they're all kind of not thriving right now because of the inflation costs and the margins and the cost of doing business. The operational side of the house is not particularly in their favor right now. Also, because of inflation, a lot of consumers are now being a little more cautious of how they spend their money, especially when eating out. Case in point, Chipotle reported their earnings last week, and instead of giving the market a bullish guidance and forecast, they literally relayed what I just said to you, that more and more consumers are choosing to eat out less and to eat at home more often to save a little bit because the cost of everything is through the roof. So with McDonald's, this is something that I'm balls deep into because I truly believe in them. So even if they experience a temporary setback, at least for like the past 3 months, they're not doing too hot. I think if you're not invested into McDonald's, it might be a really good opportunity to jump in. So case in point, right now they trade for like what, $2.94? If they were to dip and they drop down to where they were back in the summer at like $2.50, $2.45 a share, I think that's a really good chance to jump in. Because when you think about McDonald's, it's one of those dividend compounders with cheese that I don't know how they do it, but for the most part, they always find a way to reach a new high. Case in point, a good sanity check is if you zoom out and take a look at a stock's chart history, you can see what they do. And in the case of McDonald's, they always find a way to go up. Regardless of the market noise, regardless of any scandals or anything bad that's happening with them, they always find a way to rebound and win. This is a company that has it in their DNA to keep growing, to be a consistent dividend payer, and prioritizes the shareholder. Case in point, ever since they've been publicly traded, McDonald's is up by 83,000%. And that's only taken into consideration the stock price appreciation, right? When you think about their dividends as well, it's probably a lot higher. Right now, the dividend yield, I think, is pretty respectable with a capital R, because McDonald's is not just a burger joint, right? I always talk about and highlight the fact that you need to think about McDonald's as a real estate conglomerate, meaning McDonald's owns all, or I guess a majority of the real estate of all of their franchise restaurants, meaning their franchisees, the people that run the business on their behalf, they pay rent to McDonald's. Does that make sense? So when you think about the most valuable land assets that are in urban areas around the world, such as Paris, New York City, San Francisco, and you think about the McDonald's that's located in downtown, guess who owns that land? It's McDonald's. So McDonald's has a wealth of rich assets on their balance sheet, but it's also a company that is not treated as if it's a traditionally antique company that's not going to be growing anymore. The market expects McDonald's to be thriving, to be growing. Case in point, meaning for their earnings report on Monday, if they're not growing and if they show any signs of doom and gloom, or like the consumer is not buying from our menu more often than we anticipated, the market will overreact and sell out of McDonald's. But I don't know what it is with McDonald's. Every single time there's a sell-off, look at every valley that you see on your screen right now. They always recover, no matter what the scandal is, no matter what the... do you remember when people were protesting against McDonald's and they were boycotting it, like in the Middle East and whatever? What happened as we fast forward? The market pretty much forgot about all of that already. So it's a company that always seems to find a way to rebound. I think what I'm trying to say, it's a long-winded way to say, it's one of the more safer and better investments that you can make in the stock market, especially for a beginner or even for a veteran. The volatility with McDonald's is pretty remarkable. I really like this company. Payout ratio is 62%. They've been growing their dividend payout for the past 50 years at a rate of 8% year over year. A pretty spectacular company. I am going to be keeping my eyes on McDonald's Monday to see what happens. And I think they report before the bell opens, so we'll be pretty much able to see what happens at like 9:30 when the market opens. Hopefully it's going to be good. I don't know. I'm not going to sit here and pretend like I know what's going to happen. And then, of course, there's Prospect Capital, which was one of the BDCs featured in my BDC ranking video. I'm just going to reserve my tongue because I was taught growing up, if you don't have anything nice to say, then don't say it. So I'll just leave it at that. Prospect Capital. And then also on Monday, we have Hain Celestial. Or I guess Hain Celestial. It's a company that's all about like the organic, healthy, natural ingredients, and they make snacks and household products that you can use to apply on your skin. And I'm not gonna lie to you, this company is kind of future thinking and future forward. And I think in the is it RFK? Yeah, RFK Jr. era for the next 4 years, I think this is a company that won't be struggling too much because they don't really copy the business model of the other snack companies that use a lot of artificial ingredients, sweeteners, and colors and dyes. Hain Celestial has been like, I guess, sacrificing profit margins in order to use better ingredients. I promise this is not an ad for Papa John's, but to use better ingredients that are more natural and organic in their portfolio. Would I ever invest into them? Most likely not, but as a consumer, I genuinely enjoy their veggie straws. I think it's pretty dope. So Monday, not too exciting. However, as we jump over to Tuesday, this is where it gets pretty busy. Tuesday, Wednesday, and Thursday, absolutely crazy. Okay, and there's certain sectors and industries that are all the big dogs are going to be reporting. Case in point, the hospitality industry. But Tuesday, we have Shopify. If you don't know what Shopify is, they're basically in the business of helping you to open up an online platform so that you can do your e-commerce product or service and to sell it. They are an integrated platform, so you can have that website and payment processing all in one. Would I invest into them? No, I think it's a pretty fine and dandy company, but I'm not particularly interested in Shopify. And then there's Coca-Cola, which seems to be a dividend favorite among the investors for good reason, I think. I think it's Warren Buffett's probably favorite company of all time, besides maybe American Express. He really likes Coca-Cola. For me, I did my deep dive and I had to pick between Pepsi versus Coca-Cola. And for me, I went in the direction of Pepsi. So that's just me. And a company that I'm particularly interested in Tuesday is going to be Humana. So Humana is in the health insurance industry, but not for the commercial side of things. They primarily cater towards the Medicare, Medicaid, and TRICARE health plans. So they specifically are reliant on government subsidies and government paybacks to ensure the sick, the ill, and the elderly. Does that make sense? So if you're not aware, Medicaid and Medicare, that's the health insurance that you get in the U.S. based on your age, disability, poverty, illness, whatever it is. And then TRICARE is the health insurance that is given to the U.S. military. So I'm invested into Humana because when I think about the health insurance industry, I made a deep dive video about Humana, and there were so many different players in this space. And ultimately, what I concluded is when they depend on the government, right, there's going to be highs and there's lows, right? It really depends on the administration. But what I'm going to say is, do you really think you're going to be the president that goes down in history that removes or cuts or reduces the budget to ensure the 85-year-old grandma who needs health insurance through Medicare? No, I don't think so either. So I feel like anything to do with the government paying you, especially defense contractors and health insurance related to the government, for me, I'm bullish on. I don't think it's going to go anywhere. When the current administration is talking about reducing and cutting the fat and trimming the government expenses, they're talking about the stuff that doesn't really need to be there. Does that make sense? But the essential stuff, that budget, that revenue is going to stay intact. They're not going to reduce the military pay budget or the military industrial complex of building out jets, tanks, submarines, and health insurance. All of that stuff is going to stay. Or, I mean, of course I could be wrong, but that's what I'm assuming. Now, Humana, for the longest time, before people started talking about, health insurance industry being evil and everything, for the longest time, this is a company that has just been skyrocketing, right? However, once that narrative has entered into the minds of politicians and the younger generation of the health insurance companies, I mean, look at what happened last year, right? There was a CEO that got assassinated. Health insurance is not a very sexy industry right now. Consequently, I mean, you can see it reflected in the share price of Humana, and you can see it in United Healthcare. You can see it in Cigna. It's just one of those companies that, or sectors that is just out of favor with the consumers. However, in the U.S., I'm not saying this is right or wrong. However, here in the U.S., we have a broken healthcare system and model. The fact that there's a health insurance industry that profits off of greed. And I'm saying this as a guy who's invested into Humana, by the way. I hate health insurance companies. I hate them so much. But we have a system in place with so many lobbyists fighting on their behalf that I don't think this model is going to go away anytime soon. So as a result, if I hate it and I can't change it, then I might as well invest into it. At least that was my investing thesis for the most part. Humana is absolutely undervalued right now. And let me think about it like this. So Humana has a peer in Molina, right? Molina posted their earnings last week, and they hinted at the fact that they were struggling, right? They missed their earnings per share because they lost their Virginia Medicaid contract, and they're saying we have overall higher Medicare cost. So their margins are being crushed, which is why it makes sense the EPS was not to the expectations of the analysts. So when I saw that, I suddenly got bullish towards Humana. So if their competitor is struggling, I mean, of course, Humana is also going to struggle with the higher Medicare medical costs, but if they just lost Virginia, that's ground for Humana to take over, right? I don't know. I can't say that I have high or low expectations. Whatever happens on Tuesday, I'm probably just gonna continue to hold because high quality company, dividend compounder. I like the company. I don't like the industry, but it is what it is. Right below them, we also have Leidos, which is a defense contractor. I think it's a pretty solid company, but in terms of what I am interested in, I'm more so, there's two of them on my watch list. I have Lockheed Martin and Huntington Ingalls. Fortunately for me, Huntington Ingalls had a hiccup, a temporary setback, and they pooped the bed last week in their earnings. Their stock went on a sell-off. I started buying at the bottom of that sell-off, and now they're recovering, but I still think Huntington Ingalls is a really good price. But I think Leidos is actually it's a pretty good defense contractor if you're looking into this sector. And then there's S&P Global, which pretty popular stock because of a popular YouTuber who really likes it. For me personally, I'm not really bullish on them. It's a credit rating agency, and they have an entire index named after them, right? The S&P 500. So they have like an economic moat. They have a brand, a name that's recognizable, a economic toll booth, monopolistic type of business. It's a good thing, but it's just, I don't know. I just feel like they're overpriced. So for me, I'm a pass on S&P Global, but they're also reporting. And then the first of the hospitality industry is going to be Marriott. They're reporting. I have yet to make this video, but I have my research done. I just need to turn on the camera and film. But I laid out why I think the hospitality industry is a really good place to invest into. You know, contingent upon a pandemic not happening and shutting down all the doors and, restricting travel. But for the most part, hotels, really cash cow machine of a business model. And Marriott, I think, is pretty good. We also have DoorDash reporting and Lyft. I would categorize them in the same sphere, like that ride share. You order something on a mobile app and someone delivering it to your house. Not really interested in them. And then there's Welltower, which is a REIT specifically catered towards healthcare facilities and centers. They're featured in my REIT ranking video. And I don't really think too high of Welltower, I'm going to be honest with you. And also on Tuesday, we have Zillow Group, which is an online realty company where basically you can just find a house that you want online and you can interact with the realtor through their private messaging system or through email, and you can buy a house. So it's changing the way, I guess, buying and selling houses are done. However, I don't know what to feel about this company. During the pandemic, they ballooned up in valuation, right? However, once the rug was pulled from them, they crashed so hard. Case in point, they reached the high of $202 in February of 2021. I think that's also when GameStop and all of the meme stocks went on a rocket ship. But ever since then, this company went on a massive sell-off and they have not recovered. So if you had bought into Zillow because they went on a dip from their whatever this was, when it was $202 and it dipped down to like $147, you'd be like, dude, it went on sale by like $56, $57. I'm getting a good deal. Well, if you bought in at $147, you would still be in the red with this one. Would I touch Zillow? Absolutely not. Do I like their business model? I do. I think it's great. That's why I'm also a fan of the online car marketplace type of businesses as well, like Carvana or CarMax. I like when we can digitalize the traditional modality of having to go in person and to deal with someone, and that's like, oh, we can't give you this price. The best I can offer out the door is $27,000, even though online it said it was $19,000, and they tack on all of these fees and services and stuff that you don't want, and you have to haggle. I don't like that. right? So to have it be more catered towards the consumer without all of the hassles and everything is online, I'm a huge fan of. I actually like that. Anyways, I don't really like the idea of investing into them, but those are my thoughts and opinions. And then there's Agree Realty. And if you have not watched my REIT ranking video, here's a spoiler alert. This company right here is an S-tier REIT. They deal with commercial real estate. So basically, when you think about the big brand names like Walmart, Dollar General, that's who they partner with. So they have a steady and reliable cash flow monthly rental income that's pouring in every month. And their dividend is, here, let me just pull it up. Let me show you. So right now they're $72. Their dividend profile, a 4% dividend yield, juicy. Quite juicy. Annual dividend payout is $3. They've been growing their dividend for the past 10 years, but here's what I want to show. For the rest of the REIT industry, they're struggling, right? With a high interest rate environment, it crushes them. Because to expand and in order to grow, REITs have to take on loans or issue more shares. And so debt and loans and leverage is the name of the game for growth when it comes to a REIT. However, while all of their peers are struggling, look at what's happening with ADC. Sorry, that wasn't a good example. They're actually doing quite well, all things considered, because when you think about it, before the pandemic, they were trading for around like $72, and now they're currently around $72, which is relatively flat, right? Most of their peers, I would argue, are still right here in this valley. They have not recovered to their pre-pandemic levels. Case in point, I would say their competitor is Realty Income Corporation or NNN, one of those. If you look at Realty, right, this is a REIT that I am invested into. Prior to the pandemic, they were at $77 a share, right? They're still at $54. They have not recovered back to their pre-pandemic levels. So ADC is doing something right. They seem to have favor within the market. It's a company that, if given the opportunity, if they go on a sell-off, they go on a dip, I would be more than happy to buy into it. I did my homework, I did my research, I did my analysis, and yeah, they're pretty cool. Plus, ADC, I love their ticker symbol. If you play video games, that means attack, damage, carry. Other than that, also on Tuesday, we have Ecolab, which is an industrial cleaning and pest management type of company. So when you think about hand sanitizers, hand soap, water treatment, making sure there's no rodents hanging out near your warehouse or facility, this is the company. I think it's pretty high quality, a very boring business model, but pretty stable and reliable, and it's pretty good. I like that company. I should probably highlight it to show you, like, hey, if they go on a dip and they reach the price that I think is fair, I would probably jump in. And then we also have a BDC, one of the first ones, Gladstone Capital. Ticker symbol GLAD. Now, the Gladstone umbrella has so many different companies operating under them. They have so many different publicly traded companies. This one right here, GLAD, is their traditional BDC, meaning they hand out loans to middle market businesses and they help mentor them and to help them grow. And yeah, it's the traditional one. It's the more safe and steady method when it comes to a BDC, quote unquote safe, because inherently people think the entire industry is really dangerous, but I made a BDC ranking video and I go over why that's a myth. If you know what you're doing and what to look for, they're not all created the same and they're all evil and scary. That's just not the case. But yeah, GLAD is reporting, and then here down, I guess later in the week, we'll talk about one of their more riskier BDC varieties. And we also have WK Kellogg, ticker symbol KLG. They had a spinoff and they created Kellanova. It used to be all part of the Kellogg's umbrella, right? And now they branched off. Kellanova is associated with all of their snacks, and WK Kellogg is what we think of when we think of Kellogg's, which is the cereal. Am I bullish on this one? Absolutely not. I don't really like it. If you want to invest into cereal, snacks, and Blue Buffalo, which is pet food, I feel like the better play for a safer CPG food company as General Mills, but I don't know. And last but not least, on Tuesday, we also have WP Carey, ticker symbol WPC. This is a very high quality REIT that also does commercial real estate, and not too long ago, they actually did a spinoff and let go of all of their office buildings. Pretty high quality company. I wouldn't say it's as high of a quality as Agree Realty, but it would probably be right below them. It's a pretty good school. And I also think it's the biggest donor for Arizona State's School of Business. So that's a little fun fact for you. And as we jump over to Wednesday, we have CVS. This is a company where, after doing my research, I found out that they are absolutely undervalued. CVS is reporting on Wednesday, and let's take a look at their stock chart. So after I did my homework and I found out they went on a massive sell-off, like over here, and I guess when I initially bought into them, I bought into them right around, I guess this is not a good portrayal because it only shows you like the price they closed at, but it did dip even further. I bought into them when they were around $48, $47 a share. So I am in the green with CVS, but this is a company where the sentiment and the expectations super bearish, super fearful, and the stock market just does not like CVS, which is weird because I did a deep dive, I guess like a few months ago to find out which companies had the best returns in the stock market's history. And believe it or not, CVS was a part of that list up until they went on this massive sell-off, which is, I guess, warranted as the health insurance industry is now out of favor with investors and with, everyone else in general. But when I see that happening, I'm like, well, I guess here's my opportunity to buy into them on the dip. Pretty high quality. It's a top to bottom complete healthcare company. They're trying to copy the business model of United Health, which I would argue is a pretty good tactic and strategy. Not only do they do the pharmacy aspect, but they also have health insurance, and they also had little minute clinics, right? So they have everything under the sun when it comes to healthcare. When we take a look at their dividend profile, it's just shy of 5%, and the payout ratio tells us it's pretty safe. But I would argue CVS is pretty darn risky, right? Not because of the retail arm of the business, which I really don't like. I like CVS because of Aetna, their health insurance arm. I don't like the physical retail side, but they are inherently risky because when you think about like Rite Aid, they're not doing too hot, right? But when you think about Walgreens, which is another competitor to CVS, they reported their earnings last week and they crushed. So if Walgreens crushed, which is a company that everyone thought was going to go bankrupt, then I have a pretty positive feeling that CVS is going to report good earnings as well. That's my take. I could be wrong, but that's what I think is going to happen. And by the way, I want to jump back to S&P Global. What I want to say is this: even though I'm not really interested in them, I am invested into one of their competitors, which is NASDAQ, ticker symbol NDAQ, and they crushed their earnings last week. So if you think about S&P Global and the stock market side of their revenue generating business, NASDAQ is pretty much doing the same thing. Because when you think about the QQQ, the NASDAQ 100, the best 100 tech companies, they also generate revenue from all of the different ETFs that utilize that name, like the NASDAQ 100. They have to pay royalty fees to NASDAQ, but NASDAQ does so much more than that. They're also trying to pivot into becoming like a cybersecurity firm for financial businesses and for anyone who's a stock brokerage. Pretty solid company. I made a deep dive about this company, I want to say like back in 2023 when they were right here, like 47 to 50 bucks a share. And I was screaming up and down saying they are so undervalued. And since then, they've just been skyrocketing. I would say they're one of my better investments that I made in the past year and a half. Pretty happy with NASDAQ. However, if you think about S&P Global on the credit rating side of the house, they have a competitor called Fair Isaac, right? Ticker symbol FICO. They also just reported their earnings last week and they missed their earnings expectations. So it really depends on what side of the house is going to bring down the ship, or are they going to keep going up? I don't want to play, doomsday when it comes to S&P Global because it is pretty high quality. And for the most part, they have been doing pretty well. So I guess we'll see what happens to them on Tuesday. That's all I wanted to say before I forget. And then, of course, on Wednesday, we also have Kraft Heinz, which is a CPG food company. They do everything ranging from snacks to cheese to, here, let me pull it up, to condiments like ketchup and mustard. So you might look at this and think they're undervalued, and I think they are as well, but it's one of those things where you have to ask yourself, am I bullish on the future of Kraft Heinz? Is the growth story believable? And I don't know. I don't know about all that. Past 5 years, they're flat, which makes sense. A lot of the food CPG companies are not doing too hot right now. But here's what I want to show you. If you click Max, right? They started publicly trading back in 2015 at about $77, $79 a share. Since then, they've just been in the red. So when it comes to Kraft Heinz, I just don't know. I feel like it's in their DNA to not thrive and not grow. And I also want to point this out. This is why I don't think they're undervalued and why I think they're a value trap. Soak in their dividend profile. You might be like, wow, $29, 52-week low, 5% dividend yield. My goodness gracious, until you see that, it's not going to be sustainable. If I were to make an educated guess, Kraft Heinz, if they do not grow their numbers, which have been pretty much flat for the past 4 or 5 years, right? I'm looking at their revenue and saying that assessment. This dividend is going to go bye-bye. A payout ratio to be 143%. Their earnings cannot sustain their dividend payout. So with this company, I don't even know you and I'm trying to do you a favor. I would probably avoid. I would not want to go near them. There's other food CPG companies that are on the dip, are actually undervalued and have a winning recipe that thrive in the stock market that are going through a temporary setback. Case in point, I would argue Pepsi is a better alternative. I'm invested into them. I just pumped money into them a few weeks ago when they went on a sell-off because they missed their earnings. Much of the food CPG companies are struggling right now because the margins are just being slapped left and right. But when you click Max, take a look at that. Pepsi at least has a winning recipe, right? When you think about Kraft Heinz, the confidence is just not there. And as I look at their dividend profile, a 3.7% dividend yield is still pretty respectable. And the dividend payout ratio means it's sustainable. But the difference between Pepsi and Kraft Heinz is that they have a history to back it up, history of excellence, 53 years of growing their dividend payout. Very solid company. I can't, in good faith, say that Hershey is another good alternative because I am also invested into Hershey, but I would argue that Hershey, with what coca prices are at right now and their margins just being squeezed out of their right nipple, I would argue they're also pretty risky in terms of like Hershey versus Kraft Heinz versus Campbell's. They're all pretty much in the same territory. But Pepsi, I would argue, is probably the best food CPG undervalued play right now. And as we think about the other companies that are on Wednesday, we also have Restaurant Brands International. This is the parent company that has a whole host of brands under their umbrella. They have Firehouse Subs, which, funny enough, they just acquired not too long ago. They have Popeyes, they have Tim Hortons, they have Burger King, and I think they have like one more company. Can't remember off the top of my head. Let's just pull them up. I believe this is a company that Bill Ackman went balls deep into because of the Burger King affiliation. Did we mention everything? Tim Hortons, Burger King, Popeyes, we mentioned all the businesses that they have. So they're also reporting, and then we have Reddit, which is I think they just IPO'd last year. It's pretty new. But they went on a uproar and a rocket ship to the point where I just don't know if you're getting a good deal with them right now. I mean, they're $225, but had you invested into them during their IPO, you would be a very happy person, which a lot of investors say do not invest near or at an IPO, because the stock price is always going to crash because of the equity holders that are trying to cash out, because it takes time. Like if you go work at a startup, it takes time for your equity to vest, right? It takes like 3 years or 5 years. Once that opportunity arises, most of those people cash out. But then what happened with Reddit is it's kind of interesting. Let's take a look at their history right now. So the IPO back in March 2024 at about $46 a share. I'm not even going to lie to you. I was eyeballing them. I was like, should I jump in? Should I not? The reason why I couldn't is because of this right here, negative earnings per share. I was just like, dude, I don't know if I can sleep soundly at night knowing I am invested into a company that has negative earnings. So I didn't. I sat on the sidelines. I watched them. I think they're still on my watch list. At this point, I should probably delete it after making this video. Since then, it went from 46 to what it is today at 225. So in the span of 1 year, this company went up by 564%. So when you think about Peter Lynch and multi-baggers, a company that goes up 5 times, 10 times your original money, in a span of 11 months, you would have 5x'd your money with Reddit. It just goes to show, like, you can't really listen to the wisdom of don't buy near IPOs for every single company. I think it should be broken down into specific case by case. For Reddit, I really wish I would invest into it. But when I looked at their fundamentals and financials, I don't know, like the revenue is growing and everything, but if you look at their earnings per share, this is what was scaring me. It went from negative $2.40. Sorry, let's back it up to fiscal year 2020. It went from negative $1.23 to negative. It just got worse and worse, right? And that's why I was like, I don't know about this one. Because when you know that a company has negative earnings, their margins and their profitability is just not there yet. And so as a result, I just couldn't do it. Their free cash flow, though, they're finally positive. So that's a good thing, right? It went from negative to what it is today at positive $104 million, which means they're doing good. And I think that's because they're plastering ads all over the website, and you can start buying stuff to make your account look better. Solid company. I think it's very overvalued right now. I wouldn't invest into it. Then we also have Robinhood, which is a stock brokerage platform. Not really a fan of them. And we have Dutch Bros, which pretty much do the same thing that Starbucks does, except the consumer perspective for Dutch Bros, the young people really love them. Reason being is that their drinks, like they all know, it's unhealthy, but it's colorful, it's sugary, it's sweet, and the flavors are out there. It's more wild, right? Versus Starbucks. Would I invest into them? Probably not. We also have Dominion Energy, which is a utility company that operates predominantly on the East Coast. Believe it or not, I'm actually invested into them. When I started investing into the stock market, this was one of the first companies that I bought into because at the time I was getting my MBA in the state of Virginia, and I was paying electricity bills to Dominion Energy. And I was like, you know what? Based on my education, I know that this company pays a good dividend. So if I'm going to be paying them for my, having the lights on, then I want them to pay me. And so as a result, I've been owning them for a really long time now through all of the highs and the lows. Their dividend yield is 4.8%. And I don't know, I just haven't sold out of it. I wouldn't say it's the best company out there, but it's certainly not the worst either. And I would say as a whole, the utility sector is, it's undervalued. Right? Because in a high interest rate environment, it hurts them. Because for a utility company to expand, to grow, and to thrive, they need to take on a lot of loans in order to do more CapEx, to maintain, to repair, to upgrade all of their power generating sites, whether it's gas or solar or wind, whatever it is. It takes a lot of CapEx. So during the pandemic, they were able to take out loans effectively at a 0% interest rate, right? Now they're having to take out loans at like a 5, 6, 7% rate, which means it's killing them. Do I think Dominion's going to go anywhere anytime soon in terms of like bankruptcies? No, it's a utility. Utilities are about as safe as it gets. Everyone pays to have lights on in their house. You want AC in the summer? You better pay your electricity bill. You want your heater on in the winter? You better pay your electricity bill. So it's one of those safe investments that I made in, I don't know, Dominion. I'm not even going to try to tell people to invest into Dominion. I actually stay away. Stay away. We also have Essential Properties Realty, which is one of the REITs featured in my REIT ranking video. They basically do commercial real estate for small and local chains. So if you have like a car wash chain only in Detroit, or if you have like a cupcake shop that only exists in Las Vegas, but you have like 3 stores, those 3 stores are most likely owned by Essential Properties and they rent it out to you and you pay them rent. Not a bad REIT. I'll leave it at that. We also have Denny's, which is the breakfast diner. It's kind of like IHOP or Waffle House, but I actually like Denny's. Is that diabolical? Is that strange to say? I like Denny's. Would I invest into Denny's? Absolutely not. Just because you like a product or you're a fan of their food or their product or service, it doesn't mean that you have to invest into them. And then there's also Spartan Nash. This is a company where I was so bored one night, I did a deep dive, and I never made a video about it because I didn't want to waste anyone's time, because I concluded that it probably wasn't worth your money. Like saying, my way of saying, I don't think it's a good investment. So they're in the business of doing food distribution for commissaries around the world. So when you think about the U.S. military bases that are in Italy, Germany, Australia, Korea, they're the ones that are transporting and getting that food there, but they also have an off-brand label, private food that they make. And they also own a bunch, when I say a bunch, I mean like maybe less than 20 grocery stores in the Midwest. So when I think about Spartan Nash, they kind of remind me of UNFI and Performance Food Group that exists in Richmond, Virginia. If I pull up Spartan Nash right here, let me show you why I got curious about them that one night. So their trading multiple is a 13. The future trading multiple is a 9. Dividend yield is a 4.7. On surface value, it looks pretty good, right? Let me show you their dividend. It's sustainable at 65%. They're growing it for the past 10 years at a rate of 1% growth. But then I started digging into the numbers, and then I realized, man, this is just... there's sometimes we can say it's it's not a sexy business model, but it's reliable and it's growing and it's, predictable. But when it comes to Spartan Nash, I just couldn't reach that conclusion. I didn't like their debt situation, especially in comparison to how much cash and cash equivalents that they have. Right now, they have $925 million of debt to their $18 million of cash. Not a good picture. Think about their free cash flow. I get it. It's a grocery type of business. The margins are single digit on the lower end, like 3% or 2%. Their free cash flow, disgusting. So once I started learning about the financials and fundamentals, I was like, yeah, I'm going to pass on them. I'm not going to invest. So if you're eyeballing Spartan Nash, prove me wrong. Let me know why you think this is a good play. There's other grocery chains out there, right? Like there's like Kroger's, Albertsons, and my argument is going to be that Walmart is the best out of all of them. Reason being is that if you buy into Walmart because of the grocery boring business model that's reliable, stable, everyone has to buy groceries, so it's a reoccurring revenue that is predictable. If you're going to say all of that, it's going to be Walmart. Why? Because when you buy into Walmart, you also get Sam's Club, you also get the e-commerce side of their business, and you get one of the best well-run Fortune 500 companies, Walmart. I would put them up there alongside with Amazon and Costco. Pretty solid company. What else do we have on Wednesday? We also have Stag Industrial, which is a REIT that's in the business of renting out warehouses and factory buildings. I think they're featured in my REIT ranking video. I'm not 100%, but I know for sure that Ventus, which is a REIT that does healthcare facilities and buildings, they are not featured in the REIT ranking video. Spoiler alert, I would not invest into any healthcare REITs right now. And then we also have Waste Connections. So when you think about garbage, right, the business of trash, It is one of the best high quality sectors that you can think of, because not only do they have, depending on the region, oligopoly or duopoly, it's something that is always going to be increasing year after year. As our population gets bigger, as more consumers consume, trash is inevitable, right? So it's a company that I think is pretty solid. However, in comparison to their peers like Republic Services and Waste Management, which I would argue are the better, and when you think about footprint, obviously Waste Connections is the smallest out of the three, because they're the three big dogs in the space of garbage in North America. So because they have the smallest footprint, you would think that they have the biggest opportunity to grow. And I think that's because they fundamentally only operate in major metropolitan areas in the US. Whereas when you think about Waste Management and Republic Services, they offer trash and recycling and disposal almost everywhere. It doesn't matter if it's rural, suburban, or a dense urban area, they serve that space. So I kind of like what they're doing with only serving the big cities. But because of that, I'm just like, that's also holding them back from growing properly. Sorry, did that make sense? Growing properly. I've been filming nonstop for like 45 minutes, so my head is like all over the space. But anyways, it's not the worst idea in the world. I would argue that any of the three trash companies, really good deal. So Waste Connections, if you're trying to get into a company that has an economic moat that is growing year after year, stable financials, I mean, their top line is going from what, 5.3 billion, 2019, now 8.6 billion, pretty solid. But if you're anything like me, I usually like to invest into the biggest and the best of a sector. I try not to invest into the little fish. But on the flip side of that, the little fish usually has the biggest upside and the biggest potential to grow. The reason why I would prefer Republic Services against the three is because their footprint is big, they have their operations in order in all areas of the US, and I just feel like the market cap allows them to have more cash on hand, better durability in the stock market. Sorry, that made no sense. The reference that I'm trying to make is with a bigger market cap, I meant bigger, I guess better brand recognition. Sorry, I sound like a lunatic right now. I meant brand recognition. Oh my gosh, I'm stuttering on my words here. Brand awareness. My goodness gracious. That's what I was trying to say. And when you look at their numbers, it's going to be bigger. That's what I was trying to say instead of cash on hand. They're going to have bigger revenue, bigger free cash flows. And I guess in proportion to like the shares, I guess it spits out pretty much the same thing, but I just prefer to go with the bigger, better known. It's just the way that my brain is wired. And their dividend is too small for me. We'll talk about Republic Services here in a little bit. But we also have Fastly, which is in the cloud space. And then there's Gladstone Investment, ticker symbol GAIN. This is a BDC, very similar to the other one, except this one I would argue is more riskier because they're in the business of taking over and buying out and acquiring small businesses. So when you think about that in itself, I don't know. So as a BDC kind of guy, I would rather go with GLAD. The traditional BDC, like the upside and the share price might be not as great, but the volatility on the downside with GAIN is just too much for me to stomach. And then we also have Wyndham Hotels and Resorts, which is also in the hospitality space. I like this company. Would I invest into them? I don't know. We also have Equinix, which is a data center REIT, pretty high quality, and I would probably argue they're doing really hot because I looked into the other data center REITs and they're also crushing it right now. Case in point, they're about $930. Pretty ridiculous. However, for a REIT to only pay a 1.8% dividend yield, not the biggest fan. And we can understand why that's happening because their stock price is most likely outpacing the growth of their dividend yield. And that's exactly what is happening with Equinix. Closing out Wednesday, we also have Cisco. This is a company that I am invested into, not because I see the growth Cinderella story of being a 10-bagger, but because it's such a stable, reliable business that has an economic moat in the sense that there's high switching costs. Once an S&P 500 company partners and uses Cisco networks and infrastructure, they're most likely never going to switch. Meaning, Cisco basically has a reoccurring revenue source from all of the major corporations based in the US. Cisco's business model and fundamentals actually look quite nice. Case in point, let's pull them up right here. They're currently trading for about $62 a share. I made videos about them last year when they were around right here, like $45 a share. And I was like, guys, I think Cisco is undervalued. And I kept saying it, and look what happened since then, right? So I'm pretty happy with what has happened so far. As an investor, it feels pretty good, right? Let's look at their financials. But it is a company that is relatively flat. So what they're doing right now is, since their top line isn't exponentially exploding year after year, they're working on getting better margins and a better balance sheet overall. So that's their strategy in the current tense. But I think my computer is like crashing here. Oh my goodness. But it is a company that fundamentally in their financials, it looks pretty solid. And that's more than you can ask for coming out of a tech company, to have a stable operations. I didn't say growing, I said stable operations, to have a dividend yield that's around 2.5%. I'm a fan of them. Let's see. I wanted to show the free cash flow, right? Their free cash flow right now is $11.4 billion. It's a cash generating machine. Take a look at their dividend profile, a 2.5% dividend yield, payout ratio 68%. I'm a fan of the company. What can I say? What do I think is going to happen? I don't know. I can't tell the future, but I would argue they're probably going to be doing Cisco things, which means probably growing year over year at a rate of like 2 to 3%. Not exactly the sexiest company on the market, but it is one of those reliable and boring business models that happens to be in the tech space. So I like them. We also have Datadog. Now we're talking about Thursday, by the way. We also have Datadog. We have John Deere, which, from my understanding, the farmers use their products, but they're not a fan of John Deere because of what they're doing. Like, you're not allowed to repair your own equipment. And yeah, apparently the manufacturing side of it is not as good as their Japanese counterparts. So it is what it is. They have a foothold and a monopoly in rural America, but would I ever invest into them? No. I would rather invest into Home Depot or Lowe's. That's just my opinion. And we also have Crocs, which, believe it or not, they're very undervalued for the numbers that they're posting. Ticker symbol CROX. They don't pay a dividend. However, right now their trading multiple is a 6. Absolutely wild. And their stock chart is pretty sad. They're going on a massive sell-off right now because I think in their last earnings report, they disclosed how their Hey Dudes acquisition was a huge mistake because they bought Hey Dudes to diversify their shoe portfolio. But come to find out, that style of shoe, the loafer, which me and my wife, we have Hey Dudes as well. They're pretty comfortable. It was very popular during the pandemic. However, like most things in fashion and apparel, it comes in waves, right? One minute you're the sexiest brand alive, and the next you're a has-been. Case in point, Nike. That's why I made a deep dive video where I had to use an AI because I was really sick that day. I talked about how Nike looks undervalued on paper, but they are not a good investment choice. Nike's time to shine is finally over. The other brands, like from Decker's, what is that called? Hoka Ona Ona? Dude, they're crushing Nike, especially like in the running side of the house. When you think about other sports, you have stuff like Adidas and startup brands, Lululemon. Dude, Nike's reign is over. Likewise, Under Armour. Back in the early 2000s, Under Armour was all the rage. Now, Under Armour is nothing. Case in point, I think Crocs had their time to shine during the pandemic with the Hey Dudes, and everyone wanting to wear Crocs because they were working from home and comfort was the name of the game. But as of right now, things are not looking too good for them. But on paper, they do look good. Their top line is growing year over year. They were at double-digit rates during the pandemic, but now, look at that, 3%, which is still good, but it is slowing down. And I think the market is starting to price that in, which is why they're selling out of it. Free cash flow. The free cash flow situation looks good as well. I think Crocs, I don't know why they don't. They should be paying a dividend. For as undervalued as they are and to have such good financials and fundamentals, they can absolutely afford to pay a dividend. Just my take. And even if they do pay a dividend, I still wouldn't buy into them. But also on Thursday, we have Twilio. We also have, I forgot what they do. I know they're like in the cloud space, but let me see. It operates two segments. Twilio Communications and Twilio Segment. I'm not exactly familiar with their business model. I just know they're in the cloud tech space. Not really. Oh, so basically customer service solutions. So I guess that makes sense. An alternative for them, a company that I do understand based out of Israel, is NICE. They do the exact same thing. They also do AI-driven customer service platform, like that automated computer voice you talk to when you freaking call customer service because you want to return something or just ask a question and you got to go through all of their prompts. Or if you go online and you have to open up a chat window and talk to a bot, it's usually from NICE or from Twilio. I understand NICE. I don't understand Twilio. But if they're anything alike, I would argue Twilio is probably also undervalued. However, I think when it comes to the customer service space, it's not exactly something that excites me to be a business owner of. So I'm probably just going to pass. Also on Thursday, we have Applied Materials, which just the other day, I think ASML posted their earnings and they crushed. And I say that because Applied Materials, ASML, and Lam Research are basically the big three when it comes to manufacturing semiconductor chips. These guys are the ones that make the equipment that you need in order to make the chips. So if you're bullish on NVIDIA, this is adjacent play. Likewise, if you're bullish on Amazon because of the e-commerce and online deliveries, then an adjacent play would be investing into cardboard packaging companies. And there's a lot of them out there, believe it or not. WestRock being one of them, and Packaging Corp of America. We also have Airbnb. Not a fan of their business model. When you have to do 20 different things in order to check out, like to do the dishes, to do the laundry, to scrub the toilet, dude, that's not even a vacation at that point. So for me, Airbnb, if I don't like their business, then that probably shows that I can't be the only one that feels that way. So if a lot of consumers feel, annoyed by Airbnb, what they're doing right now, I don't know what that says about the company, but in the short term, that can't be too good. And obviously, that's a very biased take because that's anecdotal and that's my own experience, but it's just how I feel. And there's also Palo Alto Networks. Nobody, including you, nobody knew what this company was until Nancy Pelosi started, throwing millions of dollars into. And after that, we were all like, oh, we get it now. She was pumping money into it because they're thriving. I think as of right now, they're still crushing, right? Let's pull it up real quick. Pull out 5 years. Yeah, they're up by 371%. Case in point, whatever Nancy Pelosi buys, I usually end up doing research on because she buys it for a good reason. It's either going to have a government contract coming their way or she knows something that we don't. So if there's any politician in Congress that you want to monitor closely, it's probably Nancy Pelosi. There's also Wynn Resorts, which I reminded you earlier, right? Almost the entire hospitality industry is posting their earnings. I think out of the entire bunch, I guess I should say this part. The only one that I would be interested in investing because I did the most homework on and the financials and the fundamentals looked good is Marriott. That's the one that I would particularly be interested in, but I don't think you can go wrong with any of them. Well, I guess I take that back. I guess out of the luxury ones like Hilton, Wynn, and Marriott, I think they're good, but I think there's some budget ones that I don't know. The ones that are running motels and whatnot, I don't know about those ones. And then we also have Republic Services, which we talked about earlier. They're in the business of garbage, which I should throw this out there. I don't think Waste Connections is a direct peer to Republic Services because of the footprint and scale and the amount of financials and numbers they're able to generate. So instead, I think a peer to Republic Services is Waste Management. Now, they posted their earnings last week, and they actually missed. Now, I want to show you what happens when a garbage company misses their earnings. They go on a sell-off, and then they recover right away. That's why I'm saying that garbage companies are some of the best investments that you can make, because they always seem to find a way to recover and rebound. I think it's because all of Wall Street understands their business model has an economic moat beyond belief. But when I started to look deeper into Waste Management as to why they missed their earnings, come to find out, the operational costs are kind of hurting them right now, like the price of fuel for all of their trash truck drivers and the wages they have to pay for them. Because during the Great Resignation, a lot of the blue-collar workforce, they were quitting, right? And to keep your talent, you got to pay them more. So they're still dealing with that aftermath. And then also, I found out through Waste Management's earnings call that the recycling commodity prices are dropping. So in 2024, it went from $92 per ton. When you think about recycling commodity prices, it's basically how much they earn per ton of recycled material they sell to the people that use it in order to build something else. Okay, so it's going from $92 per ton, and in 2025, it dropped down to $85 per ton. So when you think about it, Waste Management and Republic Services, they're about to make less profit in their recycling line of business. And by the way, if you don't know about this, recycling is not a sexy, lucrative, cash-generating industry. The money is made in garbage disposal, especially like hazardous material and just junk in general, oversized junk. Recycling, I would argue they lose money on. So to get even less money per recycled ton, that's not good. So if anything, I think Republic Services is probably going to follow suit like Waste Management, and they'll probably miss on their earnings as well. I know that's a hot take, but if that is the case and they go on a massive sell-off, could be a buying opportunity. But seeing as how they just went on a dip and they just recovered even prior to posting anything, I don't really think we're going to see that much of a discount on Republic Services. Also on Thursday, we have Federal Realty, which is a REIT that was featured in my REIT ranking video. They basically operate properties centered around grocery, open space shopping centers. So have you ever been to an area that has like an Aldi or a Trader Joe's, and then surrounding it, you have like the most random stores nearby, like Dunkin' Donuts and like Party City and a Dollar Tree? They usually own all of the businesses on that shopping block. That's Federal Realty in a nutshell. And we also have Hyatt, which is another big luxury hotel chain. And then we have Hercules Capital, which is a BDC. We have Digital Realty Trust. That's a REIT in the business of doing data centers. Pretty good, but I don't think they're undervalued at all. So I guess I should make a clarifying statement. When it comes to REITs, I think everybody is undervalued right now except those that are data center REITs. So anybody else, fair play, undervalued. But the ones that are housing the most valuable sector, at least for the next 3 years, data centers, overvalued. And then there's Wendy's, which I think is pretty hilarious. If you invest into Wendy's, you gotta let me know. It just makes me laugh. Investing into Wendy's. I guess what's funny is if you're gonna invest into a burger chain, Why not McDonald's, right? Office surface value, this is pretty good. Their trading multiples 15. Dividend yield is just shy 7%. If we zoom out 1 year, oh my goodness, they're hovering around their 52-week low. I would argue I genuinely enjoy eating at Wendy's, which, by the way, is really funny. Some of my favorite food is the most dirty, vile, unhealthy food that you can think of. And I have a six-pack, which is pretty hilarious. I love McDonald's. I love Wendy's. If we zoom out 5 years, yeah, they're at basically a 5-year low. They're hovering around their pandemic lows right now, which pretty crazy. Yeah, their dividend is going to be cut any second. 106% payout ratio. That is not good. Let me just take a look at their financials. What's going on here? The top line is growing year over year. That's pretty good. Take a look at their balance sheet. Cash and cash equivalents. We got $480 million. What's their debt situation? Ooh, $4 billion. My goodness, that's some heavy debt. How's their cash flow? What's the profitability like off of their operations? You know what? I can't believe their free cash flow is positive. This is kind of crazy. I wonder what's going on with them. I did not do my homework with Wendy's. It's just like Jack in the Box. I'm just not really interested in investing into them. The only burger chain that I keep up with is McDonald's. But if you think this company's undervalued and you do your homework, could you follow back up and let me know, like, what's going on? What's going on with Wendy's, man? Also on Thursday, we have TransUnion, which is also another credit reporting agency. And I would argue out of the batch of them that are in that side of the business, I don't know if they're the most undervalued. Let's see. Their trading multiples in 83. Let's see what FICO is. FICO is 85. So I'm going to guess that S&P Global is also around 85. No. So I guess out of the three that do credit reporting, which is a monopolistic business in itself, this one is the most undervalued in terms of their multiples valuation. But anyways, TransUnion, almost the exact same line of business as FICO. And then we also have Yelp, which I don't understand how they're still in business. You know, I thought maybe like Google would have destroyed their business model, because essentially what Yelp is you can use it to find a business in a specific area. Say you're traveling to like, I don't know, Albuquerque, New Mexico, and you're trying to find Mexican restaurant. You can type that query into Yelp, and it'll show you each business, the photos of said restaurant, and you can look at the reviews to see whether or not you want to go there. Doesn't that sound a lot like Google Maps and Google Reviews? Now, the difference is Yelp has a subscription model where if you are a business, you can pay Yelp in order to have your business front-loaded on the search results. So say like in Albuquerque, there's over 400 Mexican restaurants. If you pay Yelp based on the tier, you can be front-loaded and be the first one to pop up, the second one to pop up, or the third one. And statistically, if you're a consumer and you're freaking hungry and you just want to shove a burrito in your fat face, do you think you're going to go all the way to page 40? No, right? You're most likely going to settle and pick a Mexican restaurant on page 1. So as a business, it would behoove of you to pay for Yelp to front load your business. But I don't know how much longer they can survive. I get they're a technology company with a platform that used to be a monopoly, but I think Google is tearing it up. And Google does not charge businesses in order to be posted in search results. So actually, do they? That's something I would love to look into, whether or not Google makes you pay so that when someone searches Mexican restaurants, you would be the first one to pop up on Google. I always assumed that it was based on popularity, like the restaurants or businesses that have the most reviews are front-loaded when it comes to Google. I don't know. But Yelp, not going anywhere near. And then there's also Molson Coors, which is an alcohol brewing company, but it's not like one of those draft, small beer players. This is a conglomerate that has a whole umbrella of beers in their portfolio, and that's the parent company of Blue Moon, which, believe it or not, is one of my most favorite beers. And I don't know what it says about me, but another beer that I really like is Stella Artois, and it's been about like a year and a half, maybe 2 years since I had a drink. So pat myself on the back for that. I haven't had a beer in a while, but if I were to have one tonight, it would be Blue Moon. This is a company that I think alongside with Samuel Adams, I think all of the beer companies are struggling right now. Because I think what we're finding out is that the younger generation, especially those that are 29 years old and younger, they're not gravitating towards alcohol like our other generations did at the same age bracket. Instead, the younger ones, and when I say younger, I mean like the 23-year-olds, 27-year-olds, they're utilizing vaping, those tobacco pouches like Zen, and they're using the green herb. That's what they prefer. Alcohol is struggling right now because if the next generation is not finding it appealing, their revenue is going to be hurting, right? So in the future, I don't know if the long-term thesis for alcohol companies look good right now. Samuel Adams. Oh, let's see, pull it up right here. Gosh, what's that? I forgot what the name of that company is. Is it Samuel? What's that beer company? Okay, whatever. If I remember, I'll pull it back up later. But I looked into some of the other alcohol stocks about 2 years ago, and then I realized once I did my research about the trends of the consumers deviating away from alcohol consumption, I was like, okay, I'm not interested, which is funny because when you think about the Slavic countries or Eastern Europe and Asia in particular, Thailand and South Korea, dude, they are drinking alcohol like there's no tomorrow, okay? So it's kind of interesting to see consumer behaviors that are changing and shifting around the world. Let's see. On Friday, there's only one company that's kind of interesting, but not really, and that's Treehouse Foods. They're basically in the business of doing off-brand, private label foods for businesses and companies. Like, let's say, have you ever been to a Target and you see how they have like their own Target branded cookies or bread? Most likely made from Treehouse Foods or from UNFI or the other private food label companies. Not exactly a company that I'm interested in. For me, I would rather buy into a company that could have brand loyalty, such as Pepsi. But that's just me. Anyways, that's the companies that are reporting their earnings this week. I apologize for stuttering and, tripping all over my words in the middle of the video. I had a brain fart. I'll try to get better at that. I'm doing this without any script, so I am proud of myself. I usually have like a full-blown written script. But I'm trying to get better and better, and you can only get better through practice, right? And I'm practicing by just, looking at what's on the screen and then just communicating to you as if you're sitting across from me and we're just sharing a beer, at a pub and we're just talking. Like that's the idea that I have in my head rather than being like a news anchor, reading straight off a script. So that's my promise to you. I'll try to get better as I practice more often. So what do you guys think? What are you watching this week? Which companies do you have in your portfolio? What do you think is going to happen to some of their earnings reports? I got to look into this one. What was that other beer company? But anyways, I love you guys. Stay safe, and I'll talk to you next time. Peace.